Hello, everyone. I'm Butch Pakani of UNAP's Principles for Sustainable Insurance Initiative. Welcome to the second event of the Sustainability Leadership in Insurance International Virtual Event Series convened by the PSI and Swiss Re. Today, our main focus will be on sustainability risks in underwriting. We're delighted to have hundreds of participants from across the globe join this virtual event. And before we start, I'd like to share some information and some house rules. So this is a public event. We'd like to be interactive, so along the way, we will have online poll questions and Q&A segments involving the audience. And you will see this on your screen, the online poll questions for you to participate. And also, in order to access the poll and the questions, you need to go to slido.com and enter the code A249 or scan the QR code. Okay? So just to be clear, so that you will be able to participate through the online poll and the questions, please enter the event code A249 or scan the QR code. Okay, with that, enough with house rules. Let's get cracking. In our first event last month on the pandemic situation and sustainability, which included Swiss Re's Group CEO Christian Mumenthaler and UNEP's Executive Director Inger Andersen, it was highlighted that the world has a monumental opportunity to build back better from the COVID-19 pandemic and the human tragedy and economic disaster it has wrought worldwide. The opportunity is to build back better in a more resilient and more sustainable way. It was also underscored in that first event that global challenges, be it COVID-19, climate change, biodiversity loss, or ecosystem degradation, require solidarity and urgent collaborative action for all, and that a healthy planet is fundamental to having healthy people and a sustainable future for all. This is why the aims of global policy frameworks like the UN Sustainable Development Goals, the Paris Agreement on Climate Change, the Sendai Framework for Disaster Risk Reduction, and also the upcoming Post-2020 Global Biodiversity Framework are all key factors in ensuring prosperity for all, healthy people, and a healthy planet. So today we have 3 sessions that will enable us to better understand how the insurance industry can be part of the solution and contribute to building a healthier, more resilient, and more sustainable world. So let's dive straight into our opening dialogue on sustainability risks in insurance. This session will outline the case for company sustainability strategies and related sustainability risks for insurers and reinsurers, and how they can be managed by an insurance company. And we'd like to get some market and supervisory perspectives on this agenda. So we have, for this opening dialogue, we have the privilege of having Patrick Raflaub, the Chief Risk Officer of Swiss Re, and also Pamela Schurmans, the Principal Expert on Insurance Policy at the European Insurance and Occupational Pensions Authority. Just to get going with some scene-setting slides, our slides will be limited, and it will only be me who will be showing some slides. Let's get on with the first slide. So from a PSI master narrative, the role of the insurance industry in sustainable development has 3 roles. The role of a risk manager in terms of understanding, preventing, and reducing risk. The insurance role of carrying risk and de-risking the transition to a more sustainable economy, and obviously the role of institutional investors as well. So these are 3 principal roles. This series that we're doing with Swiss Re will focus on that left side of the triangle, looking at the underwriting side, the insurance side of the house. And this will be the focus as well of our discussion today. Let's get on to the next slide. And today, just to highlight that in the succeeding breakout sessions, we have actually big things to launch and discuss. The first is the first ever global sustainability guide for the insurance industry with a focus on non-life insurance business. Has been done before. It's now out there today in the next session. In this other breakout session as well, we will cover a commitment by insurers around the world to protect tackle biodiversity loss and ecosystem degradation through the angle of protecting natural World Heritage sites. And in that breakout session as well, we will see the launch of a WWF Swiss Re report on spatial finance. If you don't know what it is, find out later on. But these are big things coming up. Let's focus on the task at hand. And I'll give it to you, Patrick, for some opening remarks on what sustainability is at Swiss Re, the strategy of Swiss Re, the journey you've had. The floor is yours, Patrick.
Thank you, Butch, and thank you to all of you for joining us here. It's a pleasure for me to be representing risk management and Swiss Re in this on this panel, in front of this group. My name is Patrick Raaflaub. I'm the Chief Risk Officer of Swiss Re. And I would like to really just make 2 or 3 short remarks, and I really look forward to the discussion and the questions that we can discuss later. I would like to basically highlight 2 beliefs, 2 fundamental beliefs, which I think are fundamental for our approach when it comes to advancing a sustainability agenda. One is we believe in a integrated and as broad as possible risk management approach being superior, and I'll come back to that. And secondly, we believe that sustainable business in the long term is good business. In fact, it's the only good business in the long term. I'll come back to that also later on. Starting with the risk management aspect. So in the 90s, Swiss Re was one of the first companies to adopt a truly integrated risk management framework, which integrated all various types of risks into one framework. Also established risk and reinsurance at the time division, a chief risk officer role as a member of the executive committee. This by now is established best practice. Obviously, other insurance companies have followed. The Solvency II regulation in Europe has made it almost compulsory, and also other regulatory frameworks around the world have followed suit. But I think it's important to go back to this time when where it is all about integrating all known risks into one framework to make sure that what we do is really considered from as many angles as possible. It also has the advantage that established risk control instruments, such as limits or approvals, just the whole governance machine that typically exists and existed on more quantifiable risks, can be applied also to sustainability or sensitive business risk. And with that in mind, we look back to a history of more than 20 years of a sustainability risk management, or a sustainability angle of risk management integrated into what we do. Initially mostly focused on topics such as climate change, water, and human rights, but also already in the late 90s around internal environmental management. This has led us most recently to several commitments, actually reinforcing the ambitions. And just to point out 2, so Swiss Re has committed to a net zero greenhouse gas emissions in operations by 2030. And maybe we'll come back to that later. So net zero is really means net zero. It doesn't mean offset someplace else. And internally, we discovered there's a lot of also, even internally, even with Swiss Re employees who are quite well versed when it comes to carbon neutrality. There's a lot of misconceptions about what that means. So this is an ambitious goal. And obviously, the other one, which is structurally even more ambitious, but we can't do it alone at all, that is the net zero greenhouse gas emission across our entire business, where the ambition is to be net zero by 2050. So maybe I leave it at that when it comes to the risk management approach. The other thought or the other basis was what I mentioned before, is this belief that only sustainable business is good business in the long run. And this really puts the sustainability agenda at the heart of our commercial activity. And this is sort of what we have built and what has emerged as our next step. And we are currently in the process of taking it. And what we are realizing is that there is a lot of existing business that very well lines up with the SDG agenda, but sometimes it just needs to be differently communicated and also differently calibrated. And so with that in mind, we look at the sustainability agenda not only from a risk perspective or from a defensive perspective, but really also from an offensive perspective. I think in the interest of time, I stop here. Maybe we can go back to the framework based on the discussion or any questions. So back to you, Butch.
Thank you, Patrick, for that overview of basically Swiss Re's journey, and also the two pillars that you mentioned about integrated risk management, managing downside risks, but also matching this with a strategy on sustainable business as in terms of upside opportunities. I just wanted to quickly follow up, Patrick, based on what you've said. Swiss Re started, as you mentioned, way back in the 90s, and so what was the trigger for developing such a strategy and a framework on sustainability for Swiss Re? Just because each company, I mean, we have hundreds of folks listening right now. They can have their respective characteristics. Not everyone is a global reinsurer like Swiss Re, but I think from a Swiss Re perspective, what was the motivation for Swiss Re to get into this, and what were some of the challenges along the way?
So from a sustainability perspective, because I think that's how I understand your question. I wasn't there, so obviously I don't know. But how the discussions went. I mean, there were two themes really that are also anchored in the Sustainable Business Risk Framework: is human rights and environmental protection. Now, the environmental protection angle has been a topic or a theme within Swiss Re for a long time before. If you are a insurer of natural catastrophe, you cannot avoid being aware of the environment. We should also not forget that the environmental liability, that's a theme of the 80s, which has hit the insurance industry hard. And also you could not be aware of the very significant cost of cleaning up environmental or pollution at a later stage. So I would venture, but we would almost have to go back and talk to my predecessors at the time whether that is true. But I would venture that it's very much just being concerned about the long-term viability of our business model is what really triggered the more systematic approach.
Thank you, Patrick. So it's also very interesting. I mean, I think the long-term view and foresight of an insurance or a reinsurance company is key to this. And you mentioned examples like environmental pollution liability. This is not something new. This is something that has happened in the past. You also mentioned human rights. I think these are very interesting angles that you have mentioned, because from people can have different interpretations of sustainability, and for some it would only be a climate narrative. But you had mentioned that this actually is a broader environmental, social, and governance lens that includes human rights and other issues like pollution out there. And I know your framework also covers ecosystems. That's a really interesting starting point. So we'll get back to you, Patrick. At this point, I'd like to turn over to our colleague at EIOPA, Pamela Shermans, to give us some initial thoughts on, from a supervisory perspective, on this agenda of sustainability risks in insurance. Pamela, the floor is yours.
Thank you, Butch. Can everybody hear me well, Butch? Yeah, can you?
Yep.
Okay. So thank you very much for having EIOPA at this event. And in light of the pandemic, it's timely as ever to talk about the role that reinsurers and insurers can have in ensuring resilience in our society, but as was mentioned before, also in securing their business model in these very dangerous times, if we say it. My name is Pamela Schuurmans, and I'm a principal expert in insurance policy at EIOPA, and today I'm dedicated since 2018 to sustainable finance. And I would like to mention 3 points as a starter, maybe to get the discussion going. So in EIOPA, the European Insurance Supervisor, since 2018, we have been working on setting the expectations to insurers and pension funds on how to take into account sustainability risks and factors. And we had two very important objectives in pursuing this work. One was to make sure that insurers play their role as insurers in managing and mitigating the ESG risks. And that is the traditional role of the insurers, to take on risks which society wants to transfer. And of course, to continue to do so in light of climate change, for example. That's the first objective. The second objective is that insurers and also pension funds adopt a sustainable approach in their investments based on principles of stewardship. And these two objectives clearly entail two main points. It shows that sustainability considerations would apply both to the asset side and the liability side. And I think there has been more work in the recent years, or in the 20, 30 years, on impact investing. There may have been less thought to impact underwriting, if you could call it like that. And a second notion that underlines these objectives is that insurers are being called not only to consider the impact of sustainability risks on their balance sheet, how they fare, for example, under climate change, but that they would also take into account the adverse impact of their investment and underwriting practices on the environment or society as a whole. And that was mentioned before, and that's what some people also call the double materiality, or the inside out, outside in approach. So that's the first point. That's what is driving us in working on sustainable finance. Now, the second point would be what is particular about integrating sustainability in the underwriting strategy. And there are two particular angles. And so far, we've been mostly focusing on the E side of ESG, on the environmental, and in particular on the consequences of climate change. So what are two particular angles I would like to highlight? One is in the underwriting strategy of a company, there is the risk assessment capacity of an insurer. And the second angle is the potential for an insurer to actually incentivize risk prevention. To briefly mention the first one, and we can come back on that later, the risk assessment capacity. It is actually the job, or the dedicated experience and knowledge of insurers to put a price on risk. And this is reflected in contractual terms and obviously in the level of the premium. And these can send very strong signals to the outside world on whether risks are too high or extremely high, and maybe also not insurable anymore. And with this strong signaling through their contractual terms or through the premia, insurers can actually promote risk prevention behavior. And that is a second point. For example, in setting the terms of its underwriting or setting the level of the premia, an insurer should consider, for example, to require a business contingency planning from a company to limit the insured losses of business interruption caused by a nat cat, be it by physical damage or non-physical damage. Or, for example, you mentioned, Butch, the Build Back Better. An insurer can actually require flood resilience measures to limit the losses that would occur from a flood. And these measures do have the potential of actually lowering the risk, and this should be in the interest of the insurers. It goes to the viability of their business, and also this is in the interest of society as a whole. So we are working on this, what we define impact underwriting, or how actually insurers can contribute to risk prevention. And that leads me to the third point, the last point, which is building on this risk assessment and on the risk prevention that an insurer can do. They can limit the losses that arise from these events, but it still may be, and we see it very clearly today in the pandemic, that risks are simply uninsurable, that the price is too high, that people will not pay it, or that insurers will not insure. So after risk assessment, risk measurement, and risk prevention, there's of course a possibility of residual risk transfer. Mm-hmm. And that is an important topic we see coming up in the pandemic, is that there shall be a very careful and very objective layering of risks across the insurance industry, across capital markets, and potentially where needed with national or supranational support. And in doing so, we should make sure that everybody has skin in the game to actually first do a very good risk assessment and actually invest in risk prevention. And these are my three introductory points which could help the discussion. Thank you.
Thank you, Pamela, for those insights. I just wanted to ask, I mean, you mentioned quite a bunch of items there. You're saying that EIOPA is looking at sustainability issues across both sides of the balance sheet, both on the underwriting side and the liability side. And I'll touch on again on that interesting angle on the prevention side. But I just wanted to check, you know, given EIOPA's mandate across Europe, you know, how has this sustainability agenda been embraced by the market participants? I mean, obviously there's Swiss Re, but there are other market participants there across Europe. How is this going from your perspective across EIOPA's jurisdiction, this agenda of sustainability?
Thank you, Butch. And for those who may not know EIOPA so well, so we work actually with supervisors across Europe. So the first step we have to take there, of course, Butch, is to convince our own supervisors that this is a risk and an opportunity to take also in the daily supervisory activity, and how these risks can materialize on the industry. Now, last year we have conducted 2 consultations on our advice and on our opinion. And of course, what we see is that the industry is very receptive. It may have changed in the last 6 months, but at that time, the industry is very receptive. But we also see that in practice, when it comes to measuring the risks and to taking concrete preventive actions and to invest more in prevention and in innovative solutions, maybe also to collect data, to share data, there are still some hurdles, and this is not easy, because it is all about the business model also of insurers, where a long-term perspective of longer than 5 to 10 years might also be sometimes contrary to the practice of repricing on an annual basis upon the occurrence of the losses. So and insurance industry has been involved in corporate social responsibility issues way before supervisors have thought of sustainability. So the credit goes to them. But if we come now to thinking, what are we going to do and how are we going to measure the risk and reduce the risk and take action to actually improve the resilience of society, we would have some way to go also as a supervisor to understand the scenarios, but also from the industry to go from and that would be a question I was intrigued to ask. How do you achieve a net zero greenhouse gas emission through your liabilities portfolio, if not just by excluding some insurance, but how do you do that through pricing, incentivizing, and adaptation measures? And that's where currently we are very interested to get further with the insurance industry and with the supervisors.
Thank you, Pamela. Patrick, it seems like based on what EIOPA is saying that there is a shared agenda here between market participants and supervisors. What sort of engagement between the market and supervisors do you expect going forward, so to speak, on this agenda of addressing sustainability issues, given that it's relevant to both the asset side and liability side of the balance sheet? And Pamela has also introduced a notion of risk assessment and risk reduction as key features and roles of the insurance market. Any thoughts there, Patrick?
Yeah, no, I like this trilogy very much, and I think it's the right approach. Clearly, what I would expect supervisors to be doing basically are two things. One is they can contribute to transparency in the narrative. Transparency also and maybe help also comparability, even though it's tricky because you can very quickly go down a rabbit hole also with too prescriptive disclosures or too prescriptive requirements. But in principle, I would see that definitely as a role. I also liked the angle of the contribution to internalizing some of what currently are still externalities, and I think that is also an important contribution. I would say not just of supervisors, but supervisors being part of the public sector. Then it comes down to actually the public sector role. At the end of the day, we have to make sure that there are fewer externalities when it comes to the environment and I guess society or societal degradation in general. And that's a societal responsibility which has to be done via the government. And I'm at times, I mean, not in this context, not in this discussion, but at times when talking to sort of more the hardcore financial supervisors, my sense is that because it is so hard to achieve this internalization of externalities, sometimes there is this almost this push to go the easy way and start tinkering with, for example, a prudential framework or mis-selling requirements or things like that, which have another purpose, and they can be aligned, but they cannot replace the need, for example, to internalize to internalize the cost of carbon emission, to use a current example, but more broadly. So, and maybe my last comment is I really like the aspect that it's not all about, or it's not only about carbon emissions and climate change. Clearly, this is probably the biggest externality problem that we are faced with right now when it comes to environmental degradation, because it is so ubiquitous, the emissions. But in principle, it's the rule or the framework actually applies to any kind of environmental degradation, and also of other violations of also social contracts or social obligations.
Right. Did you have any thoughts on that, Pamela, on what Patrick said?
Yes, I think it's about internalizing the externalities. It's true. It is not maybe so much an externality. It's how we are going to continue doing business and living, and there are. I think it is a bit, if you talk about the mandate of EIOPA, of course, we have a prudential mandate, we have a conduct of business mandate, we have to protect policyholders. But as Patrick said in the beginning, you can't have a sustainable business in a non-sustainable world, or the other way around. So we have to think of the sustainability, of the effect of the business on the environment too. And that's why we try to take. Of course, we have to think of risk calculation, and if there is a risk, there should be capital, etc. But we also agree that if there is no proven evidence, you can't change. You can't use capital requirements to just incentivize without evidence. We're trying to take this broader approach, where we see the bigger picture. And as Patrick said, today it's climate, but actually today it's pandemic. So we're also thinking a lot about the pandemic. It's about how are we going to manage these systemic catastrophe events. And that is the term. So it is NatCat, it is pandemic, it is cyber, it is terrorism. And the framework for that, it's not just waiting until risks are too big to handle. No, it's to set up a structure by which you promote risk assessment, you share data, you share knowledge across public and private actors. You try to prevent across public and private actors, and this includes society, the policyholder. What can I do? And that's about ownership of the risk. I mean, these risks, we all own them to some extent, and we should contribute to reducing them. And then we come up to what we would call shared resilience solution. It is you can't act in your corner and say, well, I have my price for a risk and I will adjust it every year. No, you will maybe share your risk assessment with an authority, a local government, and say, I think you should invest in a risk prevention. And then you get the ball rolling to deal with systemic catastrophe events, which are, in our globalized world, impacting all of us, and with a lot of disruptive impacts.
Thank you, Pamela. I think I'll get back to you and Patrick later on, because I really, it was very interesting for Patrick to mention and describe certain supervisors as hardcore, and there could also be some hardcore insurers and reinsurers out there. I think there is an agenda there to see how everyone can be fully on board this agenda in the ways that the both of you have described so far. Just a reminder for the audience that if you want to ask questions, please go to slido.com and enter the event code 8249 or scan the QR code that you're seeing on the screen. At this point, we also want to get interactive. We'd like to do an online poll, and you will see this on your screens right now. And this will also be interesting because Patrick and Pamela had mentioned a bunch of these issues. But we have one question for this session to check the pulse. And the question is, overall, which of the following 10 sustainability/ESG risks are the 3 most material risks to the global insurance industry? And you have a bunch of options there, from air pollution to climate change to pandemics and plastic pollution. It would be good for you to pick your top 3, and then we'll get on and see the results on how that goes. So let's just try that out and see. It's on your screens right now and at the lower half, and you can select 3 of the options that you believe to be the top 3 material risks for the global insurance industry. Okay. So there's a bunch of folks. We'll give it some time and see the results on how that fares. In the meantime, I'll get back to that. So there is at the moment climate change followed by biodiversity and pandemics. You have other issues like pollution and governance issues. Bribery and corruption is actually faring. Thanks for voting. There's the numbers are piling up. So this is not just one or two, but it's around 180 that we're looking at right now. So keep on voting, everyone. But this is really interesting insights as we're speaking right now. These are the top three that we're seeing right now: climate, ecosystems, and pandemics are three of the things that both our speakers had mentioned, actually. So it's very interesting to see this. Again, this is not as, this is just a snapshot pulse survey to see where we are, given that we have so many participants today. So thank you for your participation there. So we have a few more minutes left. And I wanted to, there's also one question that we have that I saw. So there's one question with a horizon, and what are in your view some of the biggest sustainability opportunities and risks in the next 3 to 5 years, and how can the insurance industry help to address them? We've had a bunch of ideas already, but this this a horizon of 3 to 5 years. Very quickly, perhaps Patrick, you can take a first stab on that, and also Pamela afterwards, and then we will wrap up after that. Okay?
Yeah, thank you. So I can, in the 3 to 5 year time horizon, I would put maybe two examples in. One is to do with the net zero ambition, which only works if there is a negative emission technology being developed. And it can be natural solutions or technological solutions, but to be at scale, it would have to be also majority technological solutions. And those technologies have, besides the business risk and the technology risk, they also have very traditional risk associated with them. And that's an area where I think the insurance industry can be forward and can actually contribute to absorbing or taking off the investors into this technology some of the traditional risk, and maybe they can even be a bit more courageous when it comes to take some less known risks, at least in that context. The other example I would make is more maybe more current because of the pandemic, and that's vaccination. I think we have, and we've been highlighting that in the emerging risk reports multiple times. There should be a common interest of the insurance industry and governments, government health institutions to have more invested in development of vaccines, and also have more vaccination campaigns. And I think the pandemic has sort of brought it, not the pandemic itself, but the fact that the whole discussion about the vaccines and who produces vaccines with which technology has brought it to light, that this is a largely a degraded part of the pharmaceutical industry and of the health system, and has been becoming that for a while. And I think that would be another maybe current example, which I think is going to be relevant in the next in the 3 to 5 year time frame that you put in. There's a number of examples which are already relevant and established today, and there's probably a few that are more in the 10 to 20 year time frame, but I'll leave it at that.
Thank you. That's crystal, Patrick. So Pamela and Patrick, just in the interest of time, I'd like to just go straight to the final thoughts from you. We have 3 minutes left. But I'd like to use, actually, one of the questions from our audience as for you to answer with your final statement. And the question is simple. How can sustainability risk frameworks be mainstreamed? What is needed? And this is also a very interesting angle that this person put out. How can we as a smaller company do this? So not everyone is a global insurer and reinsurer, but basically the essence of the question is how can we make this mainstream, this agenda of sustainability risk frameworks for all types of companies and all types of market participants? Perhaps we start with you, Pamela, with a short closing statement to answer that, and then we'll end with Patrick.
Yes, thank you very much, Butch. Well, the best question for last, it's how can you mainstream it? And indeed, you can go directly to the question of small and medium enterprises. I think the large companies, as always, have a leading role, yes, and they can show where the journey can go because they have the means and the resources. But I think there it is crucial that we come to a sharing a mode where it is also the opportunity for the insurance industry to actually come together and discuss in a platform about these topics and to maybe also share data, to have standardized approaches, comparable views. And I think as a regulator, we can help also setting these expectations, how we make sure that it's a fair transition to a sustainable economy and it's not ending in a monopoly of a few companies holding a black box where all the risks are being assessed and the prices are being set. And I think that is how we can mainstream it, is by focusing on a shared resilient approach and having the inclusion of all. And I think another important opportunity and aspect is there. What do we do about sustainable digital finance? How can digital sustainable solutions help in potentially supporting a more sustainable approach to pricing or to collecting data through blockchain or through the analysis of big data? And I think there is also a very large opportunity which can benefit then many more actors. Just to mention two, but I would have plenty, I guess.
Yes, thank you, Pamela, and we can talk about this the whole day. And Patrick, last word from you on this about mainstreaming.
Yeah, so I agree with everything Pamela said. I'll just add two things. Swiss Re, as well as its competitors, the large companies, they all are very public about their frameworks and what they do. So I think that's a good starting point. So it's easy to find, to access information about it. And the other recommendation would be, for example, the CRO Forum also has been producing instructions and recommendations, and I'm sure there are other similar bodies that have been doing that. So this is not something where you start in a vacuum. This is something where a lot of the work has been done already and has actually also been publicized.
Thank you very much, Patrick and Pamela. We have to end the session. I very much enjoyed this. It was an opening dialogue. You definitely set up the table for the next two sessions on this agenda. And the only thing I would add, in addition to what the both of you have said, is that I think what is clear for me in talking to the both of you is that we talk about sharing, you talk about sustainability as being goodnesses, but what you have shown in this conversation we have right now is that leading by example is a powerful way to make others follow on this journey. And from both a market and a supervisory perspectives, we have seen that from Swiss Re and EIOPA, and we know EIOPA is engaged in international forums, the same with Swiss Re. So thank you very much for your leadership, and we hope that the snapshot, the insight you've shared on this very short session has inspired others around the world and set up the table for the next session. Thank you so much.
Thank you.